Good day. Today, we're going to talk about something that might seem distant, a high-level economic concept, but it profoundly impacts your daily finances, your savings, your debt, and your investments. We're talking about the Federal Reserve and its interest rate decisions. Understanding how the Fed operates isn't just for economists, it's a critical piece of your financial literacy, empowering you to make sharper decisions on your path to generational wealth and financial freedom. The Federal Reserve, often simply called the Fed, is the central bank of the United States. Its primary mission, mandated by Congress, is to maintain maximum employment and stable prices. It achieves this through monetary policy, and its most visible tool is the adjustment of interest rates. Specifically, the Fed influences a key rate called the federal funds rate. This is the target rate that banks charge each other for overnight lending to meet reserve requirements. While the Fed doesn't directly set the federal funds rate, it influences it through open market operations and by adjusting other rates, such as the discount rate. The discount rate is the interest rate at which commercial banks can borrow money directly from the Federal Reserve itself. Decisions on this rate are made regularly, as evidenced by the minutes from the board's discount rate meetings, like those held in February and March of 2026, which are publicly available. These decisions ripple through the entire economy. When the Federal Reserve decides to raise the federal funds rate target, it essentially makes it more expensive for banks to borrow money. This increased cost for banks then trickles down. Banks, needing to maintain their profit margins, pass these higher borrowing costs on to their customers. Conversely, when the Fed lowers rates, borrowing becomes cheaper for banks, and they can offer lower rates to consumers and businesses. This mechanism is central to how the Fed tries to either stimulate or cool down the economy. Let's look at how this directly affects your debt. First, mortgages. If you have a variable rate mortgage, your monthly payments will likely increase when the Fed raises rates. For those considering a new fixed-rate mortgage, higher Fed rates typically translate to higher rates offered by lenders, reducing your purchasing power or increasing your monthly payment. This means you might qualify for less house or pay significantly more over the life of the loan. Next, credit cards and personal loans. Most credit card annual percentage rates, or APRs, are variable and tied directly to the prime rate, which moves in lockstep with the federal funds rate. When the Fed hikes rates, your credit card interest charges go up, making it more expensive to carry a balance. The same often applies to variable rate personal loans. This is why, during periods of rising rates, aggressively paying down high-interest variable debt becomes even more critical. It's an immediate way to save money and free up cash flow. Even student loans can be affected. While many federal student loans have fixed rates, private student loans, especially those with variable rates, will see their interest costs rise as the Fed tightens monetary policy. It's not all about debt becoming more expensive. Higher interest rates also have a positive side for savers. When the Fed raises rates, banks become more competitive in attracting deposits. This means you'll typically see higher interest rates on your savings accounts, money market accounts, and certificates of deposit, CDS. For those diligently building their emergency fund or saving for a down payment, a rising rate environment means your cash reserves are working harder for you. It's a good time to shop around for the best rates from different banks and credit unions, ensuring your idle cash isn't truly idle. Now, let's turn to your investments. This is where the impact can be more nuanced. Bonds are directly affected. When interest rates rise, newly issued bonds offer higher yields, making existing bonds with lower yields less attractive. This often causes the market value of older, lower-yielding bonds to fall. If you hold individual bonds or bond funds, you'll see this inverse relationship in action. However, if you're investing in new bonds or bond funds with short durations, you'll benefit from the higher yields. Stocks have a more complex reaction. Growth stocks, companies whose value is heavily reliant on future earnings potential, often seen in tech or innovative sectors, can be particularly sensitive. Higher interest rates increase the discount rate used to value those future earnings, making them worth less in today's dollars. Also, many growth companies rely on borrowing to fund expansion, and higher rates make that borrowing more expensive, potentially slowing their growth. Value stocks are dividend stocks, companies with stable earnings and strong cash flow, often in more mature industries, can sometimes be more resilient. Certain sectors, like financials, banks, can even benefit from higher net interest margins in a rising rate environment. Overall, higher rates can signal a slowing economy, which might impact corporate earnings across the board and dampen overall investor sentiment. The key here is not to panic, but to understand that market cycles are natural. Discipline, diversification, and a long-term perspective remain paramount. Focus on owning quality businesses with strong fundamentals, regardless of the rate environment. The Federal Reserve's interest rate decisions are a fundamental force in the economy, influencing everything from the cost of your credit card debt to the returns on your savings and the performance of your investment portfolio. For young adults building generational wealth, understanding these dynamics is not about predicting the Fed's next move, but about recognizing the environment you're operating in. When rates are rising, prioritize paying down variable rate debt and seek out higher yields on your cash. When rates are falling, you might lock in lower borrowing costs and adjust your investment strategy to reflect potential economic stimulus. The goal isn't to react emotionally to every headline, but to integrate this knowledge into a disciplined, long-term financial strategy. Financial freedom is built on consistent action, informed decisions, and the calm understanding of economic cycles. Stay informed, stay disciplined, and keep building your financial literacy. It's the most powerful investment you can make.